Most people ask the wrong questions about annuities. They ask, are annuities good or are they bad? But the top 1% of retirees ask something way smarter. They ask, if I put $250,000 into an annuity, how much will that actually pay me every single month for the rest of my life? Because when you see the real numbers, not the myths, not the hype, just the facts, it's easy to understand why pensions disappeared. And then it's easy to understand why smart retirees are quietly rebuilding them. Let me show you exactly how much a $250,000 annuity can pay you. And then the one mistake that could cost you hundreds of thousands if you get this wrong. A few years ago, I met with a couple in their early 60s, and they had saved around $250,000. Markets had been decent, but they were tired of the roller coaster, and the husband asked me one simple question: can we turn this into a steady paycheck so we don't have to worry anymore? And that's the real question, isn't it? Not can we beat the market, but can our money last as long as we do? So let's get into it. If you have $250,000 saved, how much monthly income can that actually produce? How long does it last? And what should you watch out for? Because here's the part most people never hear. There's no one size that fits all answer. It depends on how the annuity is structured. And that structure can be the difference between barely covering groceries or replacing a pension level income for life. Today, someone in their early to mid 60s with a properly structured annuity with a lifetime income rider can pay around $1,200 to $1,700 per month, guaranteed for life, market crash or not. And it's no matter how long you live. That's roughly $14,000 to $20,000 a year from a single $250,000 asset with no risk of losing your principal to the market. Sounds pretty solid, right? But here's the catch. Most retirees walk into a bank or to talk to a general financial advisor and say, I want something safe. So they're shown a fixed annuity or a CD style product. And yeah, those are safe, but the income, it's often really weak. That $250,000 might only pay about $800 to $1,000 per month, and usually with no inflation protection. Why? Well, because safety alone doesn't create income. Structure does. And that's where fixed indexed annuities, or FIAs, with income riders completely change the game. So think about it like this. Your grandparents didn't worry about the market because they had pensions. Every month, a check showed up, rain or shine. And that's the goal here. With the right FIA structure, your $250,000 is protected from market losses, it's growing based on index performance with caps, and building an income base that calculates your lifetime paycheck. That's how someone can start at $1,200,000 a month. And if they delay a few years, they can often get significantly more. In some cases, clients nearly double their income base over 10 years with zero market risk. And here's a quick example. Two people with the same $250,000, person A starts income at 60, while person B waits until 67. Person B could receive 30 to 50% more income just because they waited, because annuities reward patience. So it's not just how much will $250,000 annuity pay, it's also when should you turn it on? How does it work with Social Security? And how do I avoid unnecessary taxes? That's where general advice falls apart. What you need is a personalized plan. You've probably heard of the 4% rule. That's where you withdraw 4% of your portfolio each year and basically just hope it all works out. And that's fine until the market crashes early in retirement. And then the math just doesn't work. So let me show you the numbers. $250,000 times 4% equals about $833 a month. And it's not guaranteed. But with a properly structured annuity, your income is guaranteed. You don't have to guess, you don't have to hope for the money you can't afford to lose. That certainty is priceless. Let's bust a few myths before we wrap up. Most modern FIAs have zero annual fees on their base product. They offer transparent income riders, and they let you access portions of your money penalty-free. And yes, your money doesn't vanish when you die. There are options for spousal continuation, death benefits, legacy planning. So again, the structure really matters. Imagine this. The market drops 1,000 points and your friends are stressing out, but your income, it still hits your account. Same day, same amount, no panic, no losses, and no sleepless nights. That's the difference between owning assets and owning income. So if you've got $250,000 or more saved in retirement and you're wondering how to turn that into a dependable monthly paycheck, there's a short video linked below that explains how it works. You'll also see how to book a free call to get real numbers for your situation. And if it makes sense, we'll talk. If not, hey, there's no pressure. You'll still walk away with more clarity than 99% of retirees. And at the end of the day, retirement isn't about chasing the highest returns. It's about confidence, stability, and peace of mind, and knowing your money will be there when you need it, no matter what the market does. If that sounds like the kind of retirement you want, take the next step now. Click the link, watch the short video, and let's see if this makes sense for you. Thanks for watching, and I hope to speak with you soon.